For years, the financial world viewed nature as a carbon sink. Ecosystems were sliced up and sold to corporations, promising to lock away greenhouse gases. But the carbon offset pitch has stalled. Integrity scrutiny and failing markets have left institutional investors wary of the old environmental finance model. This lack of confidence led to a significant shift during London Climate Action Week. The global finance sector moved past the carbon story to address capital required for climate adaptation. At the UNEP FI Global Roundtable, the narrative moved from disclosing nature-related risks to something more active. The industry is beginning to treat ecosystems as resilience assets that can be underwritten. Major buyers are quietly moving away from abstract offset credits, now looking for physical protection. A resilience asset positions nature as protective infrastructure, using living systems to defend the built environment. For a treasury, a ton of carbon is difficult to verify and value, but a physical shield preventing a billion-dollar flood provides a quantifiable financial reality. This is possible because new financial plumbing converts raw ecological data into natural capital accounts any accountant can read. This allows a treasury to treat an ecosystem's protective capacity as a recognizable balance sheet item. Traditional infrastructure is increasingly exposed. Cities, transport networks, and energy grids were often built for a climate that no longer exists, leaving them highly vulnerable to extreme weather. Nature-based solutions act as a physical defense. Restored wetlands, for example, function as a massive sponge, absorbing surge water before it reaches critical energy or water supplies. On a major coastal road project, natural embankments can physically anchor the soil. This prevents the erosion and washout that would otherwise destroy the paved highway during a storm. Integrating these living systems directly into engineering plans lowers the physical risk profile of the entire project. By defending the concrete, nature directly defends the capital invested in that concrete. This physical protection creates a shared vocabulary between public works ministries and global insurers: risk mitigation. Insurers calculate value by measuring how much a natural element limits payout exposure. A mangrove forest reducing hurricane damage directly reduces the insurer's claim. By lowering the probability of catastrophic loss, the insurer can accurately price the policy for the entire infrastructure project. This approach transforms nature from an act of corporate charity into a calculated strategy for protecting the insurer's own margins. These financial theories are already moving into active pipelines, such as the Italy UNEP Nature-Based Solutions Innovation Accelerator. This specific instrument is open for projects that strengthen infrastructure across Central Asia and Africa. It offers design grants of up to $300,000 and pilot grants up to $1.5 million for physical deployment. However, regions like Southeast Asia were excluded from this initial pipeline, despite holding the world's densest coastal carbon assets. Many projects in that region currently lack the standardized land tenure and documented biodiversity reporting these specific grants require. Without those administrative foundations, even the most effective ecosystems remain out of reach for this new class of capital. This shift toward infrastructure protection comes with a structural risk. When an ecosystem is sold strictly as a physical shield, the biological diversity within it is often treated as a secondary co-benefit. If a project faces budget constraints, the complex and expensive biodiversity tracking metrics are cut first. This means the same integrity questions that troubled the carbon market are now migrating into resilience assets. Despite the change in mindset in London, the reality is that the financial sector has yet to move significant capital. Banks, insurers, and asset managers have shown up to inspect the new plumbing, but they have not yet committed to riding the rails. The signals to watch for next are concrete. The market needs to see the issuance of a resilience bond, a priced insurance product, or a pilot grant fully dispersed. The era of pitching nature as a fragile risk is ending. The test now is which institution will be the first to actually underwrite the resilience.